The only way that Florida will grow is through migration. There's more people dying here than are being born. So if we don't have the migration to our area and people keep dying, and then we have this silver tsunami come through, and the builders are continuing to build, you could have a period of where there's just a tremendous amount of inventory with very little demand that I think could really bring prices down rapidly. I have a unique perspective on the Jacksonville real estate market, which is probably different than 90% of other people who are in the industry. I think part of the reason is because I'm so close to the data and the information through having access of 250 top real estate agents in the Jacksonville area, seeing over 1,800 transactions follow through, understanding what is the activity like at open houses and things like this. My advice to you is to listen to this information. You don't have to agree with everything that I say. I actually expect you to disagree, and you should disagree, but pick and choose points of information that's valuable to you so you can better create your hypothesis for your business. Does that make sense? Cool. So some of this information you might not have heard before. So I'm going to go through a quick story, under 5 minutes, about me and my background. Data you probably haven't heard before, and then I'm happy to do any Q&A. So the first thing I want you to know is that the zero interest rate policy of the Federal Reserve government made me rich because I was buying properties in 2014. What percentage of price appreciation for housing comes from lowered interest rates? What percentage? Well, the typical rule of thumb is if interest rates go up 1%, how much does your purchasing power go down? 12%. These are really important facts for you to know as a real estate investor. So rates went from 3% to 7%. So how much does the purchasing power go down? About 50%. So my projection is actually that from peak that we had, which was about November 2022, to the bottom, we should see about at least a 35% decrease in home values across Jacksonville, Florida. I'm not speaking about the overall market. The market is very dynamic and unique. There's places of the country that are not experiencing what we are experiencing here. This is the second worst real estate housing market in the country. Jacksonville is, just so you guys know, behind Austin, Texas, when you look at price declines and the amount of inventory coming on. And we have the data to back that up. My prediction is that this is actually worse than 2008 when we look back 5 years from now. All right? And if you're following along, you can look at, does everybody, I have a chart here. That's what I'm looking at, by the way. You can open it on your phone. It's available for you here. So look, this is what most investors said, and they thought they were really smart and the best operators in the world. But the reality was interest rates coming down actually pushed their asset values up, and it wasn't because of adding value in most circumstances. I'm smart, successful, and make good decisions. You're just jealous of my success, and you need to work harder. That's the attitude of a lot of people today. And the reality is, last 40 years, we've seen interest rates drop almost every single year. And what is the Fed doing? Now they're collapsing the economy. We're freaking out because the Federal Reserve moved interest rates off of the zero interest rate policy. So what happened to me was I came here in 2014 and I had a negative $80,000 net worth, and I had no cash flow. I had negative cash flow because I had student loans, so I was losing about $16,000 a year. And then you can see what my net worth and my cash flow was just from the last decade, and that is primarily because of the government's intervention in bond markets to keep interest rates low, to keep housing affordable. So I was in the right place, right time, and I benefited from that. What did I do in 2022? I started selling all of my real estate. I had over 200 units of our apartment complexes. I had single family rentals, and I sold all of them because I know as interest rates move up, asset prices do what? They come down, and they come down quite a bit. Not all asset prices, usually assets that are backed by debt, because we live in a payment economy. It's all about, can you make the payment, right? That's how they get you to buy the car. That's how now we're even talking about 40-year mortgage rate, right? Terms, 40-year mortgages to try to make it affordable because the bank wants to keep you in debt and enslaved with the ball and chain to continue paying them for as long as humanly possible, all right? So here's my past highlights. I studied real estate in 2011 in an investment group. I worked at Deutsche Bank in real estate investment banking. I got married to my wife, Brittany, who's also the broker owner of Momentum Realty. I relocated in 2014. I became the top real estate agent in Jacksonville as a solo agent in 2016 and 2017 by number of units sold. And that earned me a spot to be a top 100 agent at Keller Williams. I did speaking there. We had our first kid, and then we started our brokerage in 2020. Good timing, right? That's kind of crazy. And we had another kid, and then our company started growing really, really quickly. The things that I care about are sales, content, data, automation systems tracking leverage and urgency. And you can see my family right there. We do a family reunion every single year. So family is super important to me. But what's actually happening since I came here? I live downtown in 11 East. Does anybody know where that is? Right on Forsyth. Rents there have doubled since I've been there, since I've come here. The property values have doubled since I've come here. I left Washington, D.C. because it was so expensive. I graduated from Virginia Tech. I lived in my mom's basement, just like a lot of millennials did or had to do, because it was not affordable to live there. So I moved to Jacksonville because it was ranked #2 in affordability in the country. I can no longer say that that opportunity is true in Jacksonville today. We're actually extremely unaffordable with rents and prices doubling, and it's really hard to find something that's decent under $2,000 a month. Yes or yes? Amen. It's a problem. So locals need about 70% more income to purchase a property today than they did 5 years ago. I don't know about you, but I can tell you my friends who have W-2 jobs, their income did not go up 70%. They're lucky if it went up 12% during that time period. I see nods here. So we are truly in an affordability crisis. Home prices rose 52% with the average price. This is just in the last 5 years. That's where this data's come from $265,000 to $400,000. Mortgage rates went from 3% to 7%, almost 7%. See Jamie's here. It's probably, what, 6.75% today? Maybe they come down. I know it's decoupled with treasuries lately. Affordable homes were purchased by hedge funds. Who's seen the hedge fund craze? American Homes for Rent, Progress Homes, First Key. Yes, what did they do? They predict where you move and where you're going to rent before you get there so they can push rents up and sell you that property for a higher price. That happened all the way from 2012, and Jacksonville specifically is one of the largest hubs outside of Phoenix, Arizona. We're like basically #2 or 3. Atlanta is one of the top ones as well, and they pushed prices up in the affordable price range. They bought 3-bedroom, 2-bathroom homes, 2,000 square feet, and basically turned them into cash cows. Those hedge funds now make, guess what their profit margin is on their business? Anybody read those quarterly reports? 25% profit margin. I've never seen many rental companies have a 25% profit margin, but they do because they own the underlying real estate and they've done economies of scale in single families. But it pushed up the prices and wages have not kept up. And the reality is that the consumer drives the real estate market. It's the consumer. It's all about consumer sentiment. It's how they feel if things are going to get worse or they're going to get better. So how are they feeling? It's really bad. We're like one of the lowest levels of consumer sentiment, especially here in Jacksonville. When we're looking at the purchase loans with debt, and by the way, they're loaded up with debt, that's part of the problem. And that's why I think this time is very different from the last time, is the amount of debt that consumers are holding is absolutely insane. Purchase loans with a total DTI, the debt to income ratio, greater than 43% for FHA is above 65%. More than 65% of people doing FHA loans have a DTI of more than 43%. They're loaded up with debt. They're running out of cash. This is a U.S. excess savings chart. They basically have burned through the stimulus and the cash is gone, and they're extending everything on credit cards. And who's heard of Klarna, the buy now, pay later stuff? It's out of control. I mean, you're buying a burrito and having it delivered and you're putting it on credit card and it's going to cost you 5 times more. It's absolutely insane. It's another way for the bank to extend credit to you and basically keep you working to pay off your interest. Credit card delinquencies are worse than the tech bubble crash already in the United States. So that's what that chart is. You can take a look at that. Student loan delinquencies are starting to skyrocket, and it is a massive problem, and a lot of the programs are basically, they're going to start garnishing wages come October 1st. October 1st is a date to put down because that's also when the government plans on starting to continue the FHA and the VA loan foreclosure crisis, which I don't know if anybody has actually heard about. It's something you definitely need to study because FHA alone has at least 6,600 properties that are underwater, according to my estimates, here in Jacksonville that were purchased from 2020 to 2024. The government has not foreclosed on basically any FHA or VA loans for the last 5 years because of loan loss mitigation programs. Has anybody heard about this? And if you haven't, you should, because all those loan loss mitigation programs stop October 1st, basically, September 30th. This year. What's that?
The new fiscal year.
The new fiscal year, yes. Thank you. So student loan delinquencies are a big issue. Wage growth is basically non-existent. Wages are not keeping up with inflation, as we already talked about. And the math isn't mathing. Even Realtor.com is telling you do not buy a house today. It is way overpriced. There's a chart here that says buying a home in 1985 versus 2022. It's just unbelievable the ratios that you can see there from the income to the median price. That's why consumers feel awful. Consumer sentiment has plunged to the second lowest reading of all time. Anybody else feel this way? You go to the grocery store and you look, you're like, why is it priced that way? It's absolutely insane. First-time home buyers cannot afford housing. I think you just actually brought up that stat that the average first-time home buyer age is what? 38. It used to be 30. People are putting off buying their first house and they're putting off having kids because it is too expensive to buy a house and to have kids at this point in time in the marketplace. The median home buyer now, just of all home buyers, not just first-time home buyers, is what age? 55, yes, 55, 56, yes, it's close enough. We'll give you credit. Amen. But yeah, it's just skyrocketing and it's getting out of control to where I don't know how the millennials and Gen Z, if they're not already locked in with a low rate, they're not going to be able to purchase. So there is something that's coming called the silver tsunami. Who's heard of that? Okay, well, we'll talk about that at the end of this. Because it's a huge opportunity for investors, by the way. So I'm giving you this data, but there's also like a silver lining in all of this, where there's going to be a massive wealth transfer and an opportunity for investors to come in and gobble up real estate and add value to it. But right now, for the time being, until those prices come down, 52 million people cannot afford in the United States a $200,000 house. Okay? What we're seeing is the wealth divide is mostly going to the top 10%. So you see asset prices in the stock market go up and the bottom 90% continue to get poorer and poorer, and the middle class is getting hollowed out. They're not able to buy a house. So housing inventory, obviously if the consumer feels like crap, housing inventory is going to be skyrocketing because they won't have the confidence to purchase a home. They're also not confident in keeping their job or that their job's going to continue to keep them. Builders overbuilt the last 4 years. Yes? Anybody drive around Green Cove? Nobody walks around Green Cove Springs. You drive around Green Cove Springs, you see how many new construction communities there are? That's an opportunity in 3 to 4 years from now, by the way. They have completely overbuilt multifamily. We're one of the most overbuilt markets for multifamily. We had 7,800 units come on in the last 12 months, and we have 11,000 more coming on in the next 12 months. And migration to Florida is down how much from the peak? 80%. So the reason why we had so much migration is we had people who were, coming from the pandemic time period to Florida, and they were wealthy and they didn't care what things cost because it was cheaper where they were moving here than where they came from. And that's pushed up all these prices. Those people have stopped coming, primarily. We're actually seeing a reverse of this trend where people are now moving back to where they came from, either because they had job loss, return to office, or other issues. And local population, again, is priced out. So the people who were buying were not those people. Let's see if I can get to the next slide. And by the way, the lowest, this is why I say it's worse than the Great Financial Crisis. And if you're a real estate agent, you're feeling this. But we have the lowest number of existing home sales since the Great Financial Crisis already, right now. Did you guys know that? It's already worse? Okay. And Florida inventory is skyrocketing. I saw that there is more inventory in Florida than there is in the entire Northeast. It's crazy. When you look at the charts, we're going back all the way. Let's see, this one goes all the way back to 2017. We're past 2017 in terms of inventory, and it continues to skyrocket. And it terrifies me because these builders have to finish their projects because they've already started them, so they have to finish their communities and their fire sailing properties. There's conversations I'm having with builders that are doing $100,000, $150,000 off, yes. And then there's builders who are buying down your interest rate to 3.75%, yes. They have to because they can't have the appraisals come in low by selling these properties. They'd rather buy down the interest rate and pay $50,000 to buy down the rate than cut the price so they can continue to sell their property to the next person who doesn't understand pricing locally, just to be honest with you. And purchase applications are also below the Great Financial Crisis. And a lot of the purchase applications are coming through. There's been a recent spike in them, but that doesn't mean that they're actually going through to purchase properties. They're actually delaying their purchases because they're seeing how much the mortgage payments cost, and they're either deciding to rent or to wait to negotiate on the prices coming down. Prices are shifting very fast. This is a national chart, but it says there's 25% of properties that have a price increase last month. I'm seeing 33% of properties in Northeast Florida have a price increase each week. Decrease, yes, a price change within a week. So it is a race to the bottom. And by the way, we are in busy season. We're in the thick of busy season. Busy season ends in like basically 2 to 3 weeks when school starts. And we usually see a decline of number of transactions fall by about 50% going into the end of the year. So you're gonna, if you think it's slow now, it's likely to get a lot slower moving forward. Hey, look, I see everybody's like kind of like your face is going a little poo-poo. But this is information that you need to know because it's really important if you're an investor and you're buying a flip right now. Yes, Rob, right? Like we see it, right? There's distress out there with some of these flippers out there who expected to sell their house in 3 months and now it's taking 6 to 8 months and they're getting delayed. Prices are down in the South. You can see that chart there. And this is just a meme. It says the market is softer, but my house is so special. Let's hold out for more offers, which is always the case. Whenever there's a market change, right? Prices go up basically is like a staircase, and on the way down it's like an escalator. Real estate is an illiquid asset. It takes time to sell. It's highly emotional based. Sellers are going to take their property off of the market if they can't sell it and then try again next busy season, which is hilarious because most of the time it's going to be a lot less. It's probably going to be worse next year than it is this year based on the data that we're seeing. So we're seeing a record number of expireds and canceled listings. Expired means it reached the end of their term, and then canceled means they canceled it for some reason with the realtor to take it off of the market. Record number of expired and canceled. That's why we only have 11,000 listings on the market. If we didn't have those, we'd be up to 20,000. All right. This is a really cool chart. If you haven't seen this chart, it basically shows you the differences between seasonality for home prices. It shows you what months are the hottest, where prices go up, and then which months they tend to go down. It's really good to show a seller in terms of timing the sale of their property. And it basically shows us today that we're doing pretty much as bad as we were doing in the 2011 time period from a housing price improvement. Thank you for that. No worries. There was wild speculation and now there's pain. So you can see where the hedge funds were buying the most. And that's also the areas that we're seeing the most pain today. Okay, because it was artificially inflated by hedge funds that were driven by the Fed, which was also artificially inflated. So everything is manipulated by the government. If you haven't figured that out by now, you should start to realize that that's actually, as I get older, right? I'm 34 years old. I'm like, man, the government manipulates like everything. And that causes speculative bubbles in certain areas, and Jacksonville is one of those areas. So look, it's different from 2008 for sure, but I actually believe it's worse. I think the speculators who bought a lot of houses will lose their money. I was been posting a Substack newsletter since 2022 telling people, please evaluate your rentals to make sure that you might want to cash out your equity because we think prices are going down. There's also something called occupancy fraud. Who's heard of occupancy fraud? Yeah. Occupancy fraud is when somebody goes and says they're buying a house as a primary and then they immediately turn it into a rental. Yeah? The Federal Reserve of the Philly Fed said that that's 33% of purchases since 2020. Do you guys know that? And they're going to start going after people who turn their house immediately into a rental. And they actually will give you a cash payment if you turn somebody in and it ends up being true. So, yeah, you can spy on your neighbor to see if they're actually, they own the house or not. So just a heads up on that. September 30th is exposing the defaults on FHA and VA loans. Delinquency on FHA loans is already 15%. And it's so bad in February, they stopped reporting the delinquency reports on the FHFA website. They stopped reporting it. The government stopped reporting the data. They claimed it was Doge, but I mean, come on, right? Where none of us are buying that. They just stopped. They just got in there and they saw how bad things are from those loan loss mitigation reports. Because what they do is they do a modification. They stop paying. They lump that payment on the end of the mortgage. They live there for free. That's your tax dollars having somebody else there live for free, and it's your tax dollars subsidizing FHA. So it's a big issue. And there's been essentially no foreclosures for 5 years. And again, October 1st, if the student loan defaults will ruin credit. I'm sure you see with the lenders in the room, people who have that issue, if they default on their student loans and if they have a co-borrower too, it hits their credit up to 150 points, makes it much more expensive for somebody to be able to buy a house. And then the silver tsunami for Florida. So what percentage of boomers? So boomers are 61 years old or higher is considered a boomer. What percentage of boomers will be dead in the next decade? Between 40 to 80% of boomers will be dead. And what are they going to do with their real estate? They're going to either sell it before they die and move into a retirement community. There's just more inventory coming in. or they're going to give it to their kids, and then their kids not going to want the green carpet, right? And they're gonna have to sell it. And if their kid doesn't live in the state, they're going to want to sell it. And this is a huge opportunity for rehabbers to come in and rehab and improve property to get it to where the standard is today. There's going to be a massive wave, especially in Florida. How am I on time? 10 minutes. Oh, I got plenty of time. Okay. Woo. All right. There's going to be a massive wave, especially in Florida. What percentage of Florida is boomers? It's actually less than you would think. It's less than 25%. It's 22%. Yeah, yeah. But 22% of people is like a lot of people, okay? So it's a huge deal, and these houses are usually not upgraded, the majority of them that we've seen out there. So there's worsening demographics for Florida, and we have a negative death to birth rate ratio. So the only way that Florida will grow is through migration. There's more people dying here than are being born. So if we don't have the migration to our area and people keep dying, and then we have this silver tsunami come through, and the builders are continuing to build, you could have a period of where there's just a tremendous amount of inventory with very little demand that I think could really bring prices down rapidly. And by the way, rapidly is like 5 years. So in real estate terms, it's not like open door stock that changes 30% every 20 minutes. So here's another question for you. What percentage of homes were in some form of foreclosure during the Great Financial Crisis in 2008? How many homes went into some form of foreclosure? Not defaults, foreclosure. Okay? Percentage-wise. Over here? 3.2%. Look it up. It only took a little amount of foreclosures to push them off over the edge because they were all rated AAA bonds, right? We've all watched the Wall Street movies. And then they defaulted and it blew up the CDS. And then banks were forced to sell all their inventory. Does that make sense? So it doesn't take a lot to tip a speculative bubble over the other way because people are leveraged up. Now, I know there's reports out there saying, well, 40% of homes are completely paid off. That's cool. Those are owned by wealthy people. Like, that's not the general person that's coming into the market. It's like, who is the next buyer going to be that's going to buy at that price? That's the question that you have to ask yourself. And if the relocations aren't happening from California, New York, New Jersey, the northern areas or the west, who is the person who's going to be able to afford and purchase the house? The house in my neighborhood I bought it was $3,200 a month. Now the same house, if you were to buy it in the neighborhood, guess what the monthly payment is? $11,000. So I got my rate for 2.75 and now it's 6.75. All right, so within a very short period of time, the rate change has made it basically impossible. I don't know anybody in Jacksonville who can afford an $11,000 payment. Has to be somebody relocating. I can because the Fed bailed me out. The Fed made me rich. Thank you, Fed. So here's other facts, all right? I'm just going to go through them real quick and then open for a little Q&A. 68% of consumers live paycheck to paycheck. Did you know that? 68% live paycheck to paycheck. That is a crazy stat. 50 to 80% of house appreciation is due to falling interest rates. You should know that. You should know that as a real estate investor. Interest rates is the #1 factor for your business because we live in a payment economy. Florida has a negative birth rate. Migration is down 80%. Rental prices in Florida are already down how much? 10 to 20%. There's areas of Jacksonville where rents are already down 10%. What does that do to the investment market? Kills it. Kills it. People stop investing. People become scared. Start seeing foreclosures on multifamily. We're already lower number of sales in the Great Financial Crisis. Prices are already dropping rapidly. In some areas of town, it's 10 to 15% down already from the peak. You don't feel it because it doesn't happen overnight. It happens over a year. All right? So when you look at the chart and you see the price decreases, it's not like some magic event. It's just, it slowly declines and inventory slowly climbs until it becomes very clear that we're in a full-fledged affordability crisis. Affordability crisis is in full swing. Locals are getting priced out. It's now much cheaper to rent than to buy. Yes? Yes? I know realtors in the room hate to hear that. It's the truth. It's cheaper to rent than to buy, and home builders are still building. They have to finish the projects that they start. I have a chart in here that just shows you how to calculate on hot sheets. Who here has hot sheets in MLS? It's important to calculate this every week. You can calculate how many new listings, net listings are coming on the market versus those that are going off the market. New listings last week were 2,479. You add the new listings and you add the back on market, so 505, because that's inventory coming back on. You subtract out the active under contract, and then you subtract out the pending, and you get to your number, and you can see that there's 883 more net active listings within 1 week. 1 week, which is 7.3% listing growth in 1 week. But the expireds and canceleds are 771. So it actually looks like inventory came down 6.4%. It's a lie. It's because those houses didn't sell, and 60 to 70% of those homes will come back on the market in the next 60 to 90 days. So we're going to, what's that? 2 minutes, moving. Okay, so what do you do? And that's a question that I can either answer or we can do a Q&A. So what do you want to do? Tell you what to do? Well, it depends on who you are, how much money you have in your bank account, if you're a realtor or a flipper. And I have opinions on every single one of those, and it would probably be an hour presentation per perspective because we have all of those type of people at our company. And they're all trying to figure out the path forward to how they're going to monetize their business in a very fast-changing market and best prepare themselves for the next 5 years. So when we have that silver tsunami, we have prices come down 35%, how do you capitalize on making as much money as possible during the next wave up, if there is even one, which is primarily dependent upon the Federal Reserve's policies, which everybody should be studying in this room. But here's my mindset for the next 10 years. I don't think in years anymore, I think in decades. So I want to think, how do I prepare myself and my family for the next decade? How do I get access to lines of credit? How do I build the key relationships within the marketplace to build a pipeline of leads that'll come to me as an investor? And it's really relationship based. If you play it year to year, you're going to get frustrated. Not every single year is going to be your best year. I think that's important. Down markets are where you set the foundation for the next upturn. We don't know how long the down market's going to be. It depends primarily on interest rates, and we don't have control of that. You do want to partner with the best people who remain positive in bad times, because if you go negative, it's going to impact your performance. You have to think about where's the opportunity and who am I going to have fun with along the way. And of course, if you don't have grit, then you really shouldn't be a real estate investor because it is hard. And there's a lot of investors or flippers out there who are losing $40,000, $50,000 per flip, and they got caught speeding, and they didn't buy it low enough, and now they're learning and they're paying the price, and now they're smarter for the next one. But you have to have that grit to keep going. So with that, thank you guys for letting me talk with you today. Really appreciate it. Hope you got some information you didn't have before.